The consensus generally was May was the earliest that would be seeing a rate cut. But after that data drop yesterday, market traders are now pricing in a 75% chance of a quarter point reduction in February. So has this changed the timeline at all?
Well, certainly not according to the interest rate traders, but I'd point out they've been wrong for at least 12 months. They were anticipating cuts as early as February last year, and of course, as we all now know, there were no cuts. So the fact that market pricing is leaning that way might reflect the kind of books that the bond traders are running rather than a real assessment that there's a rate cut coming. In other words, their books are awash with liquidity at the moment, and that means they're looking to invest, but they don't want to get caught in a situation because at the long end of the curve, we're seeing rising interest rates, and holding bonds while long interest rates are rising is a very costly business. So they're concentrated at the short end. And while that pricing does reflect that probability, it might also reflect the fact that at the moment there's a lot of money sloshing around the Australian monetary system.
We got the unemployment rate coming out next week. What are you expecting there?
Absolutely crucial read on this one. If we do see it trending upward, it certainly makes a much stronger case. We've moved up from those historic lows around 3.5% last year, currently sitting around 4.2%. If we were to see a move towards, say, 4.5%, that might be a signal that the RBA will get off its hands. But in the absence of a strong surge upward, I don't think we'll see any change in the rhetoric from the RBA in its meeting in February. So it is a very important read. However, at this stage, the early indications and the indications we got from the CPI data is that we're much more likely to see a very modest uptick or even a flat read. And if that's the case, there's no further pressure to cut rates.